Tom Lee went on CNBC a few hours ago. I want to react to what he said about stocks, the market, where things are going from here. Let's jump into this.
Clarify, we'll only have gains if it continues its strong session today, so it won't be significant net gains. Tom, great to see you. Long time no speak.
Honest is honestly just a beautiful stock, eh?
First and foremost, what's your reaction to how the market is processed Nvidia's numbers? It, of course, fell initially in the pre-market. Yesterday morning it was doing all right, and then it did close more meaningfully down by the end of the session yesterday.
Well, I think Nvidia is one of these stocks that has become part of like a stock market lore. Almost everyone has a position. And I don't think the results and the earnings changed anyone's minds about AI and the central role it's playing in both global productivity, but also Nvidia's role. But I think the sell-off tells you that a lot of good news was priced in. I think that's why the stock fell. It didn't take the broader market down. I think that was kind of a positive outcome. And I think it just shows you that there's room for a lot of rotation. And I think that it's revealing that small caps is one of the groups benefiting from that rotation.
Let's talk about that rotation, Tom.
The reason Nvidia wouldn't take the whole market down, right, is you got to remember Nvidia's a very specific company in a very specific niche. And they're really the only ones that are really benefiting there from, obviously, the hardware, right? The AI chips right now in a massive, massive way. And so if you think about companies that could take the whole market down, you know what companies those are? Those would be actually more like advertising companies. Like, let's say, Google came out really bad numbers, or Meta or somebody like that. Because then people could look and they say, oh my gosh, the economy's bad. Right? Like if those stocks went down, people get freaked out about the whole market, the economy, those sorts of things. Apple can be one of those stocks sometimes that's kind of viewed in that way. Amazon can be one of those stocks. Nvidia is such a specific niche that, like that company can do phenomenal even though there's a ton of consumer companies hurt, right? Consumer sentiment's been horrible. Nvidia numbers have been great. They're a very special company because they're selling to the big, huge, massive tech companies. As long as those companies keep putting in these orders for these AI chips, that's all that matters in the end.
Extent to which there's still a long way to go if you're looking at the valuations of some of those sectors that haven't done so well in recent months and years, or whether things have bounced enough across the board that you start to get a little bit concerned about valuations for the entire market, not just the Nvidias of this world.
Valuations are definitely something our clients are asking us about because, the equity markets have been rising for several years. But the idea of a rotation, I think, is grounded on a couple of things. One is that the Fed's rate path is lower, and that benefits cyclical stocks and small caps. And we know there's also a lot of cash on the sidelines, and investors de-risked because of the yen crisis and just general concerns about the summer. And so I think the Nvidia results plus the Fed in September is really the catalyst that is going to get some investors to actually follow through with the rotation. So I think we're early because, for instance, small caps, I know people think they're expensive, but the median PE of a Russell 2000 stock is still 10.7 times forward earnings. That's compared to almost 17 times for the S&P. So the small caps have a lot of room for multiple expansion.
But Tom, do you want to just own the index? I mean, there's a lot of not great companies when you talk about small caps, in terms of just...
In all due respect, though, sir, same thing could be said about the S&P 500. There's a lot of crap companies in the S&P 500 that you wouldn't really want to own.
Their indebtedness, but...
You should always, as an investor, focus on the best of the best. Buy the best 10, 20 stocks that you believe will perform the most tremendous over the next 5, 10 years. Let everything else be what everything else is going to be.
Number of other metrics you might want to use. Are you telling people they should buy individual stocks or just buy the index?
I think it's both, David. We have a lot of portfolio managers that actually focus on small caps, and they're finding a lot of really attractive individual ideas with good earnings growth. But I think there is a misconception about the Russell 2000. I know there's many non-earners, but over 70% of the non-earners in the Russell 2000 are biotech stocks, and I don't think they're meant to generate...
Oh, wait just a moment. Holy smokes, this ain't no joke. Tom Lee had PayPal up there. I didn't know Tom Lee was a PayPal fan. Oh my gosh, Tom Lee, you'd be flipping my flapjacks.
Earnings, And if you look at Russell 2000 earnings in aggregate, it rose 30 or 18% in the quarter, and it's projected to grow 39% in the third quarter. So in aggregate, it's not a bad index to own anyways.
Tom, I wanted to get your thoughts on the broader economic data. This morning, PCE came in.
I don't track all the small caps, right? But what he's saying might hold some weight there, because the small caps I own, all the fundamentals of all those companies are getting better. Revenues are going up, profitability improving, margins improving. Like all those companies, like Honest, Fubo, Planet, all these sorts of companies, the margins are now heading in the right direction. The revenue's heading in the right direction. The profitability's heading in the right direction. So, just looking at the small caps I own, I'm seeing that play out. And I wouldn't be surprised if it's more companies than just the few that I own, right?
With expectations, we had GDP yesterday at 3% versus the 2.8% estimate. As we start to get ready for an interest rate cut, how much is already priced into this market?
We'll never know how much good news is priced in, but I think there was a lot of encouragement in both of the data points you point out. PCE core came in at 0.16. The upside driver there was actually financial services, which is because the stock market's up. It's showing up as inflation in PCE core. The year over year is staying at 2.5, 2.6, which means most people were thinking that year over year would actually tick up. They had negative revisions for the prior months. And on the inflation side, a 2.8 for UMISH 1 year, that's pre-pandemic levels of inflation. Consumers are always around 2.8, so I think this is giving the Fed a lot more green light to cut and focus on keeping the labor market strong, which means it's essentially acting as a Fed put going forward.
Alrighty, appreciate Tom Lee's thoughts there. Hey, it's Jeremy. I hope you really enjoyed that clip here today. Listen, there are three main areas a long-term investor has to understand. You have to understand financial statements, income statements, balance sheets, cash flows. You have to understand and master portfolio management. And you have to have the ability to project what is possible for companies in the coming years. Bearish scenarios, bullish scenarios. All these skills can be learned, and that's the good news. And I'm still just a regular guy who's out here. I just have a lot of passion for the market. I've learned a lot over the last 15 years. I had a tremendous amount of success, and I have a dedication to teaching people everything I have learned in the past 15 years. If I can do it, you can do it too. You can learn all that's required to become a great investor in my private group. The application is going to be down there in the description area. You can click on that, fill out an application, join us in the private group, get access to all my best course curriculums, teaching you everything that I got in my head, and you get ability to join our 6-figure, 7-figure Hall of Fame. We have such a tremendous Discord. It is incredible. So once again, description area down there, there's a link. You can apply to join my private group in there. See, that's the issue with some of these more cyclical companies like an Nvidia, right? Is there's a conversation. What inning are we in? Are we in the third inning, seventh inning, fifth inning, the ninth inning? It's such a negative conversation, and this is why these stocks have so much trouble eventually. As soon as people start to get a little concerned about where growth rates are going from here and a deceleration, those sorts of things, you don't have that same conversation with Microsoft, right? No one says, what inning are we in with Microsoft? No. You know why? Because Microsoft's one of those companies that you're expecting to grow every single year for as far out as the eye can see. Do we ever have a conversation around Amazon? What inning are we in regards to Amazon? No. Because e-commerce business is going to grow and grow and grow and grow and grow. As long as the economy grows, the e-commerce business is going to grow for 100 years in the future. Okay, maybe not that long, right? But 10, 20, 30 years in the future. If we think about AWS, grow, 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 grow. Their advertising business grow. There's not a conversation around an inning, right? But you look at something like an Nvidia, people say, what inning are we in? And so that's the problem with that. Palantir, you don't have that. No one says, what inning are we in with Palantir? No, you know why? Because Palantir grows quarter in and quarter out forever and ever and ever. And that's the beautiful thing with that. Is Nvidia going to grow quarter in and quarter? No. Nvidia has all of a sudden, they'll have some insane growth, right? Their stock price goes insane. Their revenue goes insane. Their net income goes insane. And then, boom, big crash, right? And then a big upcycle, big crash, big upcycle. That's the issue with those companies, because people get concerned with timing, and ultimately it hurts those companies' valuation over time, right? Which is why you look at Nvidia and you might say, gosh, man, the Ford P looks cheap if you compare it to some other stocks, right? And that's a fair statement. I mean, let's pull up the compare feature here and compare Nvidia versus like a Palantir. Look at Nvidia's at half the Ford P that Palantir's at, right? Now keep in mind, has Nvidia been growing much faster than Palantir has been growing? Yes, factually. But Palantir, we look at that and we say that company's going to grow year in and year out for the next 10, 20 years, right? Nvidia, we say they're going to grow for sure this year more. They're going to grow likely for sure next year more. Are they going to grow in 2026? Are they going to grow in 2027? I don't know. That's the issue. Are we concerned that Palantir is going to grow in 2026 and 2027? No. We all know they're going to grow, right? That's the difference. And that's what's important to kind of keep in mind in regards to stock market, the games Wall Street plays, how these stocks are valued, right? That inning conversation, it sucks for a lot of stocks because they get in that and it just is what it is.
Second and third derivative plays, both inside the data center and outside the data center.
Is it too early to be looking for those second and third derivatives, or is now the time?
We don't think so at all. So I think particularly in the industrial space, outside of the data center, as you move from GPU clusters, 300,000 to 1 million, kind of the way that these data center architectures are put together, the way that data center cooling is done, the impact on the grid, we think these are all quite investable themes. I think inside the data center, you've seen in the last 5 years, you've seen GPUs see kind of a 5x improvement in performance. All these GPUs need to be linked together, and the networking around that does that, and that's only seen kind of a 4x improvement. And so those roadblocks are typically quite good places to invest in tech, and there are lots of investment opportunities inside the data center, investing in things like networking, memories, and other big roadblocks, storage as well. So those are all big themes for us that we can invest in around the AI space.
Is that based on the assumption that huge capex spending, around $200 billion from some of the hyperscalers this year, that capex spending will continue even as those question marks become more prominent around monetization? That capex spending continues into 2025, through 2025, and how?
Well, hold on, my British gentlemen, okay? Listen here. Okay, so it's not just about these companies keeping their current spending up, right? Or, the Metas and the Amazons and all these big dogs that are ultimately driving NVIDIA's revenue. It's about those companies continuing to increase at a rapid scale how much they're willing to spend with NVIDIA, right? And so they're spending ridiculous sums of money. We all know that, right? They're going to likely spend a little bit more in 2025 with NVIDIA. When I say a little bit, a lot of them are probably going to be in the 5 to 15% more money spent with NVIDIA in 2025, kind of from what I'm hearing on these conference calls, kind of, putting the pieces of the puzzle together. It sounds like a lot of these big dogs are going to be spending 5% to 15% more with NVIDIA in 2025 than they were in 2024, which is good for NVIDIA. But the problem is 5 to 15% is not that much when you factor in how much NVIDIA has been growing, which then gets into the growth story there, right? And then what if those companies then stagnate their spend in 26, 27? All of a sudden, then you start to look and you say, is NVIDIA going to grow in 26, grow in 27, or are they going to grow like single digits, right? And then you take away the growth investor base, because the growth investors start looking, they're like, NVIDIA's growing 4%? What? 4%? People got accustomed to triple digit growth, right? And so if you slow that way down, which is very much a realistic possibility, then you start attracting the value investors at that particular time, which then you have a whole shareholder kind of changeover where you have the growth investors, right, move out of the stock. You have the value investors come in and say, this is a good value now at this particular time, which is always interesting to have play out. We saw that play out in Meta years ago, right? It went from, growth investor base and ultimately attracted a value investor base. Nowadays, it has much more of a value investor base, which is why the stock doesn't trade at a very rich valuation. If we pull up Meta here, right? By the way, if you're looking for access to 1000xstocks.com, access to my private stock group, private wealth group, I'll put that as a pinned comment down there today. You can click out that, fill out an application. We'll see if we can get you access later on this week or next week to 1000xstocks.com. But Meta, it doesn't trade rich at all. 24 forward P, and you consider the growth rates this company has are very impressive. But a 24. And the reason being is I don't know, for whatever reason, Meta doesn't attract a lot of the growth investors nowadays. It's more of a value investor base, and it is what it is.
How fundamental is that view underpinning your broader take in terms of those second and third derivative effects?
Yeah, it's absolutely fundamental. Though hyperscalers are kind of 50% of NVIDIA earnings, I think what we have seen in 2Q earnings is this divergence between investors increasingly questioning the ROI. I don't think that's the right question to ask, and management teams saying this is existential. We must invest in this regardless of returns. And you've had them, Satya and others, in various ways saying the risk of underinvestment here is far greater than the risk of overinvestment. Now, to your question, that does introduce the risk. Next year, I think visibility is very good. The year after that, the history of semiconductors would suggest that you do get these digestion periods. And in the future, that is reasonably likely as you get those periods. But certainly what the market is saying, or what these CEOs are saying, is we are going to continue to invest. And if you look at capex forecast into next year, there's a strong move up again in capex. And the problem here is not demand. The problem so far has been supply, which again that was one of the good things about Nvidia results, which is that both on the supply side, both on Blackwell, which has been a big concern for the market, it was quite strong in the commentary, and also on the CoWoS supply, so on that kind of TSMC supply that's been a big problem. That also seemed quite positive.
Okay, that's really interesting. So you have that visibility into and through 2025. 2026 becomes a little bit more hazy, maybe. Exactly. You touched on the grid upgrade, because of course the energy component in this is really crucial given the demand for these data centers. How are you thinking more specifically about investing around the grid upgrade that is going to have to happen to support this technology?
Yeah, so what could add insult to injury in regards to the Nvidia situation for 2026 specifically is, imagine we start to get a big unemployment cycle in 2025, right? We have the recession comes, all those sorts of things, and then these companies were already going to massively slow down their spend as it was, but then you add on recession on top, that could add obviously more pressure, and so that could obviously impact growth rates substantially, and then you could be talking about, do revenues go negative for a year or two, right?
It's a global phenomenon, so you can invest globally. It's not just in the United States around this. So the industrial space in particular is quite interesting. I mean, if you look at things like new data center architectures, you're having problems around kind of GPUs melting, and that's hugely problematic on what are very, very expensive data centers. And so, particularly in Taiwan, I was in Taiwan a few months ago, in the industrial space, you're getting new data center cooling solutions. So you're moving from something called air cooling to liquid cooling. That's really interesting. And then on the grid itself, there's estimates out there that are pretty punchy, but the US is expected to add something like the electricity consumption of Spain to its grid. Now, in the US, with an extremely old, underinvested utilities...
Hey, you British gentlemen, be nice to our infrastructure. We got the best electricity. Come on, man.
Infrastructure, that's problematic. And so you've got this double whammy of reshoring, where that's prompting a rebuild of the capital base in the US, alongside AI coming along and putting even more pressure on the utilities space. So there's kind of this double whammy on that part. Industrials have a role to play on the cooling side, but also how these data centers are all linked up. You're seeing far more geographical concentration in data centers as well. The grid isn't really set up for that, so you're seeing kind of more concentration in parts of the US, parts of Europe as well. So there's a lot of kind of re-architecting that needs to be done, which is going to take 5-10 years.
Ooh, okay. Hey, it's Jeremy. I hope you really enjoyed that clip here today. Listen, there are three main areas a long-term investor has to understand. You have to understand financial statements, income statements, balance sheets, cash flows. You have to understand and master portfolio management. And you have to have the ability to project what is possible for companies in the coming years. Bearish scenarios, bullish scenarios. All these skills can be learned, and that's the good news. And I'm still just a regular guy who's out here. I just have a lot of passion for the market. I've learned a lot over the last 15 years. I had a tremendous amount of success, and I have a dedication to teaching people everything I have learned in the past 15 years. If I can do it, you can do it too. You can learn all that's required to become a great investor in my private group. The application is going to be down there in the description area. You can click on that, fill out an application, join us in the private group, get access to all my best course curriculums, teaching you everything that I got in my head, and you get ability to join our 6-figure, 7-figure Hall of Fame. We have such a tremendous Discord. It is incredible. So once again, description area down there, there's a link. You can apply to join my private group in there. All right, let's get into this. Tom Lee.
Partner and head of research at Fundstrat Global Advisors, as well as a CNBC contributor. And all along, Tom, when you've made these prescient calls, some of them even short term, it had to do with positive surprises on inflation. And is that going to be enough from here on out to keep the market headed higher, or have we shifted to growth worries now?
I think there's probably more growth worries in people's minds these days. So the jobs reports and claims seem to have more market reaction. I think that's going to be the case in September as well. I mean, we have the Fed meeting sort of in the middle of the month, but this week is the jobs report. I'm sure there's going to be a lot of focus on that.
Right. So what kept you positive was that the numbers were always, for the market, they were better than people were thinking. Is that going to continue to be the case? But it's no longer inflation, it's now growth. So growth will continue pretty good. Jobs will continue pretty good. You're not worried about another growth scare like we had 6 weeks ago?
Yes, I think that the growth scare is what everyone's worried about, because the July jobs report was kind of a shock to markets, and that's part of how we had that Tokyo Black Monday. I think this jobs report for August is going to show a nice rebound for growth in jobs. Hopefully it's not too strong, because of course, as you know, if it's too strong, people are going to worry the Fed might backpedal on a September cut.
So where does that leave you in terms of what is seasonally, Andrew just alluded to it, September's not great, and we know, I mean, we always make lows in October, or we have many, many times, which means usually a lot of times September was not great.
I think investors should be cautious for the next 8 weeks. September.
Next 8 weeks, be cautious.
Yes.
You're not always cautious.
That's right. The market's been up 7 of the 8 months this year, so we know it's an incredibly strong market, but we also have the September cuts, and we have the election, things that'll get people nervous. I think in the next 8 weeks, people get a chance to buy. So I think it's good to be cautious, but just ready to buy that dip.
You have...
So here's why I'm a little suspicious, okay? So everybody knows September can many times be a rough month, many times the worst month for the market overall, right? Everybody knows that. Like, if you've been in the market any amount of time, you know September is usually bad. Additionally, you know the market usually keeps going lower in October and then bottoms at some point in October, maybe mid-October, maybe late October, right? So everybody knows that. So and everybody's talking about that as well, including Tom Lee, obviously, in this video. So I start to get suspicious when everybody's kind of on the same wavelength here, right? And so I even look at a day like today and I'm like, it's the first day of September, drop the market a bunch, right? Bunch of stocks tank, freak everybody out, get everybody convinced like, oh, yep, it's going to be a bad September, right? And then all of a sudden, it ends up not being a bad September. The market goes risk on, and next thing you know, we're at new highs at the end of September, new highs into October, right? And then everybody's like, whoa, we're flying here, baby. And then all of a sudden they're like, well, November and December are almost always great for the market, so we're going to keep flying. And then all of a sudden after that, that's when the market tanks, right when everybody's like, no, this is when the market's supposed to be good. Like, how are we tanking now, right? I don't know if that will play out. And I'm not making any prediction that that's going to be the way it plays out. I'm just always trying to think contrarian versus what I'm hearing out there. Everybody's talking about the points everybody knows, right? And I'm kind of thinking about, do we go oppo here? Do we go opposite of kind of what everybody's thinking about? And I don't know. We'll see what happens. But don't be surprised if it ends up being a fake out. Next thing you know, you're rolling higher. Everybody's thinking risk on, and then once everybody's on the risk on trade, then that's when all of a sudden the market drops for real.
Fearless, and you'll say anything. You have in the past actually talked about election-related trades and Trump trades. And did you see anything going on now that indicates anything to you? Bitcoin hasn't been acting very well.
Yeah, no, Bitcoin hasn't acted well. The two things we're watching to sort of look at how election probabilities are weighed is Bitcoin and energy. I think the fact that oil is being...
Bitcoin's on basically just one massive kind of just, slow grind lower for months and months now.
Even with some geopolitical risks, tells me I think the market is starting to bet more on a Trump election, but
because there'd be more production, bad
yes.
for price, which is not necessarily the way that you might think about things, because we hear about we're at records for oil production. No one realizes the reason we're at records in this country is because prices were so high that it caused a lot more drilling and activity, and the prices were high because it's harder to drill without and LNG and everything else the Biden administration did.
Yeah, that's right. So people think oil should be higher here for many reasons, but oil's been weak. So I'd say that's probably the market.
That's China too, though, isn't it?
Yeah, China's becoming a bit more mysterious, right? There's even risk maybe of negative GDP there.
Okay,
so oil freaks me out for next year, big time. Oil freaks me out after they start cutting rates. That's what scares me. If there's one thing that actually legitimately scares me about, we don't have the soft landing, we don't have a medium landing, we actually have a hard landing, it would be a scenario where the Fed starts cutting rates, commodities go through a boom cycle, right? And then next thing you know, the consumer is hit with that last leg of inflation that they just can't handle. And then after that, you get the big recession, right? Because I feel like up until this time, the consumer's like barely clinging on. But I feel like if we had one more wave of inflation, which could come in the form of gas prices, because most people still drive internal combustion engines, right? So they have to go to the gas station. If all of a sudden next year you saw oil go 100 plus, I'd be very, very fearful of that. And you saw commodities in general just running natural gas, everything. Because then I'd be thinking, oh boy, that would be not ideal. I don't think the consumer can deal with another inflation situation. I just really don't. And so, I don't know. Then that was a situation that obviously happened in 2008. We got that last boom in the oil cycle, right? Oil went to like $140 a barrel. People saw gas prices that they'd never seen. A lot of markets went to $4+. No one had ever seen $4+ for a gallon of gas at that particular time. That was like shocking, right? That's equivalent of nowadays like seeing like $6 a gallon for gas or something like that, right? Across the United States. It'd be pretty dang shocking. So let's hope that doesn't happen, but it is something I'm going to keep an eye on. It is something I'm a little fearful of for next year.
The next, and funny you said 8 weeks. It's almost exactly 8 weeks, I think. What's that? It's like 63 days or so. So some uncertainty and caution going into the election, but in your view, people should get long.
I think they'll get a chance to buy long, yeah. So I think this is one of those where investors need to be cautious, but in the back of their minds, no, this is a strong market.
How far down? 10%?
Good question.
I think that 7 to 10 is a possibility. And we've already had 2 7% corrections this year. So it's been testing investors' patience. But I think we should expect turbulence.
And then the question, of course, is when the turbulence comes, is it a buy the dip always?
I think
or is there going to be and by the way, buy the dip at when it goes down by 2 or 3%, or you really actually have to wait for a 5, 6, 7% pullback?
I think 1 or 2 is just almost like daily noise. This market has shown, pullbacks like that. So I think something like a 5% pullback is very likely, but I think we need.
And are you waiting for that?
Yeah, I think it. You know what? We'll find out this jobs report because. Like if it's too strong and investors worry and so the stock market's down Friday, I would be buying that dip. But there's a chance that we get a good jobs report and the market's up. I hate to sound so binary, but I would just say at the bottom line is it's a strong market. So I don't think we've seen the top for 2024. It's just that the next 8 weeks are tougher.
Okay, so that's a big comment there. We have not seen a top for 2024. So basically he's just calling for a weak September, October, and then rally November, December, which would be very customary. That's what you see many, many years.